Hey, it's Kathy here. How are you doing today? Uh, don't mind my hat. It's literally one I grabbed out of a kid's pile because I just did a workout and uh, everything's a mess. Okay, so it's just a nice cover and everyone's starting to wake up. So I wanted to shoot this video before I got interrupted totally. Okay, so that's where I am, and I'm in my nice basement dwelling, if you can see the backdrop here. So hanging out in the basement this morning, okay? All right. So anyways, let's get right to it. Today we're going to learn about the S&P 500. Yeah, it's exciting, right? But it is an important thing to learn about. This is an important index to know about when you are investing, because especially when you're investing in ETFs, exchange traded funds, which mimic or mirror the S&P 500. So you want to know what you're investing in, right? I do anyways. So let's jump into it here. All right. So today we're just going to go over a few things. Number one, what the S&P 500 index is. Number two, how it works. Three, how you can invest in it. And four, why you should invest in it. All right. Pretty straightforward. All right. So what is the S&P 500 index? It is also known as the Standard & Poor's 500, hence S&P, okay, Standard & Poor's 500. It is a registered trademark of the S&P Dow Jones indices, okay, so whatever that is. It is a stock index that consists of the stocks of 500 of the largest in the United States stock markets. Okay, so 500 of the largest companies in the United States are on the S&P 500, or in the S&P 500. It's considered the best indicator of how U.S. stocks in general are performing. Okay, so if the S&P is up, in general, stock prices are up. If it drifts down, then stock prices are overall down. So it's a really good indicator of where we're at, stock-wise. So S&P 500. Let's just learn a little bit more about it. It is weighted by market capitalization. And now what that means is that larger companies make up a greater portion of the index's value and therefore have more influence over its performance. Okay, so let's just say that again. Larger companies make up the greater portion of the index's value and therefore have more influence over its performance. Okay, so larger companies influence it more, which makes sense because they're larger companies and they're going to influence the market larger overall than any small cap or smaller little stocks, right? Companies like Apple and Amazon have a greater impact on the S&P 500 than smaller ones, such as Macy's and Harley-Davidson. And this makes sense, right? Makes sense to me. If it's a larger company, it's going to have more of an influence. If it's a smaller company, it's not going to influence it as greatly. Makes sense to me. If you hear water in the background, sorry, someone's probably flushing the toilet. Okay. Now, it is important to note that although these are 500 large companies, there are a wide range of companies. So it's not just all one sector. It's large companies in a whole bunch of different industries, okay? The value of the S&P 500 index fluctuates throughout the trading day based on the weighted performance market data. If I could speak this morning, it would be lovely. Based on the weighted performance market data of its underlying components. So it fluctuates throughout the day based on, I don't know, different factors, okay? Now here is an example of the S&P 500 to this date. So we're trucking along good, moving up. 3,400. Oh, then what happens here? Oh, coronavirus. More coronavirus, and that totally tanks in the end of March. And we're back to heading back up. Okay, so that's a good trend to be on. And later on, I'll show you the 10-year trajectory of the S&P 500, and you'll see why you should be in it. Okay, but this one here is, there's going to be ups and downs, but look at the overall trend. It's up, except for the huge crash that happened because of the coronavirus. But look, it's already back on its way up. Hopefully going to keep going, but who knows, right? All right. So here are the top 10, remember, of 500 of the largest companies in the S&P 500 as of February 2020. So here's the largest, like the top 10 largest companies: Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway Class C, Alphabet Class C, which I believe is Google, Alphabet Class A, JP Morgan, Chase, Johnson & Johnson, and Visa, right? You've probably heard of, I've heard about 80% of those companies. So, they obviously play a big role in our economy, and given that they're on this index is a good thing, because it's definitely how they perform does affect how the stocks perform, right, overall. So why is the S&P 500 the best snapshot of the market? Where am I going to put my head? I don't know. I'll just leave it in the middle. The S&P 500 consists of a broad basket of stocks without too many small and obscure companies. It contains the companies widely owned by individual investors, with the 500 companies accounting for roughly 80% of the overall stock market capitalization in the United States. So these 500 companies that are in here represent 80% of the overall stock market capitalization in the United States. So it's a really good representation of what is happening in our markets by having these top 500 large companies and no small obscure ones messing up with the data in this index. Mind me, I'm drinking my morning coffee in my Hogwarts cup. All right, so let's look at the S&P 500 versus the Dow Jones Industrial Average. And you've probably heard of the Dow Jones. It's another index to look at when gauging the stock market. So let's just compare them, the two, shall we? So the S&P 500 is considered to be the better stock market indicator than the Dow Jones Industrial Average because of two main reasons. Number one, the Dow Jones only includes 30 companies and leaves off some of the largest stocks on the market. Right, so compare that to the S&P 500, which looks at 500 of the largest companies, where the Dow only looks at 30, only 30 companies. So that's a big difference. And it is a price-weighted index as opposed to the market-weighted, which is what the S&P 500 is. And this means that companies with higher stock prices have more of an influence on the index than those with lower per share prices, even if they are much smaller companies. An example of that is Goldman Sachs, with a $238 price share, has more than twice as much weight in the Dow as Walmart, despite just being a quarter of its size by the market cap. That doesn't even really make sense, right? Like, these small companies are... Sorry, there's people afoot up here. It's distracting me. I'm down in the basement and there's people wandering around upstairs. Okay, so sorry, back to business here. So despite Goldman Sachs just being a quarter of the size as Walmart, it has more weight because its shares are worth more, which isn't a great representation of the market, right? Market weight just makes way more sense. So the bottom line, the S&P 500 covers far more stocks than the Dow, and it does so with a weighting that makes far more sense than trying to gauge the overall stock market's performance, right? It makes more sense to try to gauge the overall stock market performance, looking at all the larger companies that influence the stock market the most, than looking at the 30 companies that are weighted with price, which don't necessarily influence the market accordingly, right? So how can you invest in the S&P 500? Well, you can invest by purchasing shares of a mutual fund, or ETF, which is an exchange-traded fund designed to passively track the index. You can do this through your online brokerage. I use Wealthsimple as opposed to going to a human being. You can check out my last video on stocks, picking stocks. I use the online brokerage Wealthsimple. I will do a full review on it when I use it more, but honestly, I've only bought one share of one stock with it so far. That was easy, but I want to delve a little bit deeper into Wealthsimple before I give a review on it. But so far, I like it, and it's the cheapest that I've found in Canada. Anyways, cheapest and the most reputable, I guess I should say. So, is the S&P 500 the best investment for you? Well, legendary stock market investor Warren Buffett, I'm sure you've heard of him, has famously said that a low-cost S&P 500 index fund is the best investment that most people can make. This is because over long periods of time, the S&P has delivered annualized returns of 9 to 10%, and you can invest in a passive S&P fund for virtually no cost, right? Use an online brokerage, okay? If this sounds good to you, and it does to me, do some research and invest in an ETF that mirrors the S&P 500. My next stock market video will be on how I chose my first ETF. So I haven't done so yet, but I'm planning to very soon. So this is the graph that I want to show you is why I want to be in the S&P 500, why I want to invest in ETFs, because look at it. Look at this trajectory all the way up. Looks pretty good to me, right? Yes, there's dips, there's a little bit of valleys, dips, but you know what? If you have extra money kicking around, that's when you invest the most, right? In those dips, because you know it's going to go up again. Oops. So when you can see a dip, I got too ahead of myself. You can learn how to read the stock market in these dips is when you invest. It's like this one here, which is what I'm trying to do, even though I'll probably miss the boat. I want to be ready for the next time that there's a big dip or, but this trajectory for me, this is over 10 years, that's looking good. And chances are it's going to go back up again after this coronavirus recession or whatever we're in right now. So in summary, investing in the S&P 500 is a way to get broad exposure to the profitability of American businesses without too much dependence on any individual company's performance, right? Diversification is the name of the game, right? Over time, the S&P 500 can produce strong returns in your portfolio with minimal effort on your part. Now, it sounds awesome to me, especially as a newbie, a beginner. I'm probably going to be putting more of my effort onto ETFs rather than individual stocks until I am confident I can read how a stock is going to be doing. I want to educate myself and become better at predicting stock prices. Not predicting, but analyzing and researching. But yeah, but I'm still beginning. I'm still new. I'm learning, and this is what I've learned so far. So I hope you found it useful. It definitely cleared the air about what the S&P 500 is for me, and now I understand it. Now I feel like I can, go ahead and look at an ETF or more than one and have a better understanding of what it is I'm investing in. So thank you so much for listening or watching. If you have any questions, comments, drop them down in the comments below, and I will do my best to answer them, or at least point you in the right direction. At least give you a link to someone who can answer it, or a link to an article or something that can answer your question better than I can. But I will do my best. So as always, stay positive, work hard, and wash your hands. All right, till the next one, guys.